Hey there, beautiful Dr. Martin Luther King Day. I hope that your day is going great. The markets, of course, are closed, but we're getting ready for tomorrow. We left off on Friday with the markets pushing up against critical barriers of resistance. And of course, we're all asking the question, was this recent bull run going to be a breakout on Tuesday morning, or are the bears going to bear down on the markets? Welcome to the Stocks with Josh show. I'm going to give you guys some overview of what I see with the markets right now, as well as have a conversation about what analysts are looking for, in particular with earnings that are right around the corner. Are earnings going to stoke the flames of a bull rally, or is it just going to rain on the parade? Thanks for hitting the like, say hi in the comments, subscribe right now to be part of a fast-growing trade and investment community. Remember, anything I say is not a suggestion for you guys to buy, sell, or hold. And if you see a WhatsApp or Telegram number in the chat with my name and face, it isn't me. Those are scammers. Stay to the end. I'm going to give you guys an important 2023 market prediction. Okay, let's review the S&P 500. Now, we have a number of major problems that we have to sort out before the markets can go higher from here. The first one is our descending line, which has yet to be broken. It's a strong wall for all of 2022 that we've hit up against and failed each and every time. We have to break over it. And then number two, we have the 200-day moving average, which we are actually sitting on right now. We broke over it Friday, but that's happened at least 3 other times. And all 3 times within a couple days, it fell back beneath the 200-day moving average. And so for this move to be legitimized, we need to see a decisive move up above 200 with a back test and a bounce off of 200. Now, whenever the markets are basically below the 200-day moving average, that is classic bear zone. And whenever they're above, it's classic bull zone. And you can look at the charts to the left. The market's been above the 200-day moving average for a very long time before it eventually broke down at the end of 2021 and stayed below it all of 2022. And now, number 3 is the biggest problem we have. I mentioned it in my last video, low volume. Now, we saw the massive outflow of stocks right before Christmas. I shared it at the time. $42 billion worth of stock was recorded sold by Bank of America Global Research, and an additional $50 billion was sold from value funds and passive equities. So we have $90 billion that came out of the markets right before Christmas. A lot of people, of course, said, as well as I did, that largely this was tax loss harvesting, which we know to be true. But what we need to see right now is for that $90 billion to come flooding back into the market. And this is very eerily reminiscent of the big outflow that occurred right at the end of 2021 and before the big sell-off all through 2022. Not to mention that we still have a deeply inverted yield curve, signaling that the recession is still coming, and a Federal Reserve that is still raising rates hawkishly fast and very well may be on the verge of giving us a 50 basis point rate hike at the end of this month. The Fed funds rate hasn't been this high since the Great Recession of 2008. And at that time, the markets dropped almost 58%, which is way more than we're down right now. This market has not gone up on smart money buying. And for those reasons, I believe that the trend remains confirmed bearish. But that doesn't mean that we can't see some crazy spikes this week. Bears, in my opinion, are getting trapped and skinned right now. So use a stop loss, make sure that you've got some cash to invest, because this week is going to be wild. I'm going to give you guys my prediction for the markets in 2023 in just a moment. But first, let me take a station break for the Moomoo investment app. Click the link in the top pinned comment. And of course, for a limited time, you can get up to 15 free stock to open and fund your account. Moomoo is a zero commission, free to trade exchange. They're licensed, registered, and insured out of Palo Alto, California. They're available on your phone, tablet, and desktop computer, but only available for the US, Australia, and China market. You can trade the Hong Kong exchange directly on the app without the fear of buying Chinese companies that are threatened to be delisted by US exchanges. And I want to remind you guys right now that the Chinese economy is already doing financial easing. And the Chinese stocks, as a result, are rebounding right now. American companies right now are still under the financial tightening of the Fed, which means that we really are yet to see the potential of a reversal. Now, you guys know that I like Alibaba as a long-term investment. That's my favorite Chinese pick. Let's look quickly at earnings. Earnings and the Fed rate hike February 1st are the two biggest factors ahead of us. For earnings, there's going to be a heavy focus on the quality of margin. Analysts have partly shifted from expectations of growth because low growth can be discounted for the time being because everybody knows that we are in a slowdown. What is actually being looked at right now for this particular earnings cycle is going to be profit margin. And this reflects how well a company is responding to the economic downturn. Did they cut costs fast enough to protect their cash flow, to survive the recession without suffering the loss of market share? And will they continue to be in a position to outpace their competition when the economy recovers? So analysts are looking more at the quality of management than expectations of growth for this particular earnings cycle. Now, this is important because stocks, they do not rise in value when companies grow slower than the quarter before. I've made that point a number of times. Stock prices increase only as a reflection of growth. So whatever stock you own in a company, you have to ask yourself this one question right now. Will they outpace, out-earn, outproduce, outgrow the last quarter? Will they beat the last quarter? And if the answer is no, then you can pretty much guess that that stock will decline in value. If the answer is yes, well, then the stock will go up. So what do I see in the markets ahead in 2023? This is my prediction. What is the best case scenario? The Fed's rate hikes, in my view, are working. We saw with the recent CPI number that inflation fell 6 points to 6.5, down from the 9.1 peak that we saw in the middle of last year. Now, I believe that inflation is going to continue to fall and that the worst of it is behind us. Even if we got a spike up, in my view, that would be transitory, as many famously said, which simply means that it'll be short-lived or temporary, and it will continue to trend lower from this point forward. Remember, don't fight the trend. The fact that it's transitory reminds me of the old saying that a broken clock is still right at least twice a day. The mass unemployment of corporate America has already been initiated, and we know that they're going to continue to roll it out in all of 2023, and that's how they're going to protect those profit margins and the earnings that they're going to give us from these continuing quarters forward. This is ultimately going to drive unemployment to 4.6 by the end of the second quarter. And I believe that this is going to make room for quantitative easing because that's what the Fed has always been saying he's looking at, is the strength of the employment market and wages. I believe that that will make room for quantitative easing, and early in quarter three, the Fed will reveal his path to cutting interest rates. Now, I don't believe that he is going to be cutting interest rates by the beginning of the third quarter, but I believe he's going to reveal his path. And I think that he's going to remain hawkish in speech, but perhaps dovish in action by the middle of the year. And this brings me to my view for investing in these markets. The markets are constantly calling the Fed's bluff. It's like a swimmer in the Olympics that jumps off the podium. He jumps off too early. He potentially gets himself disqualified. The markets are so eager to put money back to work that they repeatedly risk jumping the start. Now, I have to believe that this current move up may last longer than most bears are expecting, but it ultimately will be a premature misstart. The fact that we've been in a recession economy for all of 2022 and the markets are actually less than 17% down right now, which is a sign that if you had invested in index funds, then you were well diversified, you would only be 17% down. You would have only lost 17% of your money. And even at the lowest low, the market only reached 27% down from all-time highs. This tells me that the smart money does not see that there is a justification to be selling more stocks just yet. Basic charting and technical analysis tells me that for a move to be legitimized, it has to be with big supporting volume, which in my view, we simply do not have. And we won't get it until the Fed begins to cut rates. So what I'm saying is that this market is not going to be back in a bull run until the Fed pivots, until he at least gives us his game plan of pivoting. And the fact is that the VIX is in the teens right now. And that tells us that the markets are not scared right now. So the big event ahead of us is the Fed's interest rate hike on February 1st. If he goes 25%, the rally could intensify, but it will still eventually get overbought and have to go back to retest its lows. If he goes with a surprise 50-point rate hike, the markets should sell off. And I'm going to give you guys yet again my favorite signal that I'm personally looking out for, and that's the Apple signal. Apple is currently range bound beneath this horizontal line of resistance of 136, as well as a descending line of resistance of 144. And we're above the 125. This is still going to be something that I'm watching out for. If we got a break above those top resistance lines, then I think that we would be going hard bullish. If we got a break beneath that 125, I think we're going hard bearish. That would be a huge buy signal for me if it broke significantly below to go short and to buy puts. The rest of January, though, it's going to stay choppy. There's going to be no capitulation just yet. But I will say, for a bit of encouragement, that throughout this recession, we are way closer to the end than the beginning. Hit that like. Don't forget to check and make sure that you are subscribed if you enjoyed this video. It takes heart to slay the dragon of Wall Street and to steal his gold. So throw a heart in the comments. As always, peace and blessings, my friends. I'll see you in the chat Tuesday morning.